Good morning, ladies and gentlemen. From Windsor to Cornwall and from Niagara Falls to the Sioux, I want to thank you all for joining us for today's NGCOA Ontario Chapter's webinar. Unfortunately, due to the COVID-19 pandemic, we were unable to host our annual spring warm-ups across the province over the past month. So the idea for this webinar is to try and help owners and operators navigate through all the recent government programs that have been initiated for small businesses. I'd like to introduce myself. For those who don't know me, my name is Sean Hunter. I'm the Regional Director down in Southwestern Ontario, formerly Eastern Ontario, and I'm the moderator for today's session. As well, I'd like to introduce my fellow Ontario Regional Directors, Greg Chambers in Eastern Ontario and Blair Breen in Central Ontario, both of whom will be joining us on screen throughout this webinar. Let's take a moment to go over today's agenda. As you'll see, we've got a good selection of key speakers here on today's webinar, including Jeff Calderwood, the NGCOA Canada CEO, Riley Scott, the Director of Golf Max and Business Development with NGCOA Canada. We have three experts joining us from KPMG presenting government financial help for small businesses, including Barry Travers, Partner in Tax, Aaron Jaleps from Partner with Enterprise Tax, David Ahern, Senior Vice President of Corporate Finance. Now, a couple of housekeeping items that I just wanted to touch base on before the session starts. Today's webinar is going to be recorded. In addition to the recording, we're going to be providing the entire KPMG presentation to everyone following today's session. How Zoom is going to work for our session today. As you've noticed, your microphone is currently muted. All of your cameras are turned off. At the top right-hand corner, please be sure to set it up to speaker view. Now, regarding questions during today's presentation, we've received hundreds of questions from members in advance of today's session. Most of these questions we've already given to KPMG to incorporate into the presentation that you're going to experience today. If you have questions as the presentation is going on, please take a moment to click on the chat function down at the bottom of your screen. Please note you'll not be able to see other people's questions or any responses to those questions, but we will be reading those questions and we'll be incorporating them in and asking them as time permits throughout the session. So please let us know if your question needs to be anonymous. So now, without further ado, what I'd like to do is introduce the CEO of NGCOA Canada, Mr. Jeff Calderwood.
Thank you, Sean. Good morning, everyone. I'll be brief so that we allow maximum time for the main purpose of this webinar, but I did want to make a few remarks. Firstly, on behalf of the NGCOA Canada Board of Directors, I do hope that you and your families are staying healthy. From the beginning of this COVID outbreak, we've kept health and safety at the forefront as we navigate through the related business concerns. Those business concerns are significant, though, and probably the most serious disruption that the Canadian golf industry's ever had to deal with. So the NGCOA Canada has been almost entirely focused on supporting you since this outbreak began. The solutions obviously aren't easy to accomplish, so I do thank you for your patience and your support as we work hard behind the scenes on your behalf. In general, I think our team's doing a pretty good job in that regard, even though there's still a lot yet to be accomplished. Kind of a quick recap, you've been receiving our COVID bulletins, a total of 14 so far for Ontario. With important updates that are both immediate and interpreted specifically for golf course operators. For the record, we've been doing similar for each province since the issues and the timing do vary across the country. Our website, ngcoa.ca, also has a COVID resource center, a centralized spot for all relevant information that's archived for you to access. Our private Facebook group has provided real-time peer-to-peer exchange between yourselves right across the country of best practices and opinions for you to access, and that's been very, very active. Our staff team have also fielded over 100, an average of over 100 golf course inquiries per day from golf courses looking for consultation, so we've been busy. We're also calling out with an outreach program to every single NGCOA member to offer additional support in any way that we can, specific to their unique situation. That's something we've never done before, the exceptional situation that this is. And of course, we're doing webinars such as this one today, provincially and multiple times on different topics across the country. In terms of advocacy, the NGCOA has acted quickly and I think we developed very comprehensive health and safety recommendations as an early stage. We've been persuasively then communicating those to all government authorities that impact your right to do business and how you would. Once again, I think we're leading with health and safety, consistently positioning golf as one of the safest activities to comply with physical distancing and sanitary management. And it's important that we resonate with government on that level in order to collaboratively come up with the solutions that we need for our business. And then, of course, we're also promoting to them all the benefits, such as, benefits to society, such as much needed exercise, mental stimulation, fresh air, et cetera, all those virtues that you're very familiar with. As you know, we did accomplish the essential maintenance exception early on, allowing golf courses to be ready to open when the moment is right. And our current focus on lobbying is all about ensuring that golf is positioned to be in the early stage as Premier Ford prepares to phase in various business sectors. We're working closely with our allied associations in that regard to present one consistent message, and thank you to them for supporting the NGCOA Canada's leadership in that regard. And we're leveraging key contacts that many Ontario golf course operators have with those key decision makers, in particular the Jobs and Recovery Committee. I do want to close by thanking all of you, I guess, who have contributed to any of these strategies, and a special thanks to our 3 chapter advisory boards here in Ontario, as well as our regional directors, Sean mentioned, Greg Blair and himself, who've put in some very long hours to lead the process, along with many others within our staff team in support behind them. Sean, I think I'll leave it at that for now. Everyone's in for a pretty informative KPMG presentation in a few minutes, and just wish everyone all the best for a healthy and successful season once we do get it going.
Wonderful. Thank you very much, Jeff. I appreciate you joining us for today's webinar and sharing your thoughts during this busy time. So now what I'd like to do is introduce my colleague, Riley Scott. Riley's the director of GolfMax programs and is going to speak for a couple minutes on how our GolfMax suppliers have come to help you right now during this time of need. Over to you, Riley.
Thanks so much, Sean. As Sean mentioned, my name is Riley Scott, and I'm the Director of GolfMax and Business Development for the NGCOA Canada. I want to thank you all for joining us today. I feel at home speaking to our 3 Ontario chapters since I grew up in Southwestern Ontario, went to university in Central Ontario, and now reside in Eastern Ontario. So thank you so much for joining us from across the province. I do want to start off by thanking our NGCOA Canada Platinum partners. Those are Club Car, Integra, Moneris, Moosehead, Tion, and Toro. These partners support all NGCOA Canada events and initiatives and are integral to the success of the association, especially during challenging times like these. The support received from our Platinum partners make all the advocacy we do across the country possible. I'm just going to touch on a few of our GolfMax suppliers, again, very quickly, leaving most of the time for our guests at KPMG, and then a brief overview of a couple opportunity buys that we launched last week. So start off, again, longtime Platinum partner of the NGCOA Canada, Club Car. Anyone that's been to the conference in the last couple of years has seen these. Club Car reached out to us asking if we could, again, just share the message with the Temple Walk. More and more orders are coming into Canada, so you'll certainly be seeing them at member facilities across the country. But again, just a reminder, this autonomous caddy is a great alternative to golf cars and certainly promotes the social distancing that we've all come to expect on the golf course. Next, 3 GolfMax partners who have stepped up and done something to support our members during these challenging times. First off, Tion.com. This isn't necessarily something they've done differently, but just a reminder as to how they are here to help. As always, Tion provides our members and all golf courses across the country online booking, but that also includes online payment, online check-in, and something they launched at conference last year is online food and beverage orders. So all your food and beverage orders can be done remotely through an app, and that includes payments. So when we're looking for creative ways to, get the food and beverage spend and be supporting our players on the course, Tion has a number of different ways that they can help, again, during these challenging times. Next is Deluxe Payroll. Deluxe is actually hosting a webinar tomorrow. I'm sure most of you know Kyle Campbell, former member of the NGCOA Canada, and now is responsible for association sales with Deluxe Canada. The 3 months of free HR services is what Deluxe is offering. Those non-Deluxe customers, they have a unique offer for you as well. So I strongly encourage everyone to reach out to Kyle. They do have a webinar tomorrow. They have one at 1 o'clock and 2 o'clock that I strongly encourage everybody to join in on. And lastly, on the GolfMax side is Moneris, one of our largest partners in 750 golf facilities across the country. And they have increased their tap limits to 250 on all units. There shouldn't be anything required at your end. You may just have to reinitialize your PIN pad, but it should all be set up and ready to go. Next up is some opportunity buys that we were able to launch. This all went out last Friday, so hopefully everyone has seen this, but did just want to follow up on it quickly. Falcon Golf is a touchless ball retrieval. NGCOA Canada members do receive a 10% discount. This is coming from the United States, but you can get a set of 20 of these for around $500. And I just wanted to say that the kind of the unique thing with these guys is that they actually launched this product 2 years ago to help people who have a hard time bending over to pick the ball up. And they've tweaked it to for the ball to spill out as soon as it passes the grass. So this isn't a prototype product. This has been in the market, tested and proven, and really excited to be able to offer this to our NGCOA Canada members. Kender's water solution has commercial cleaning and disinfecting solutions. It's a super concentrated formula with disinfecting as low as 75 cents a gallon. And that's with our members receiving a 25% discount. And finally, Westkey Graphics is producing, along with Exhibita, sneeze guards, physical signage, and floor decals. With a 5% discount for NGCOA Canada members. Again, this went out on in an email on Friday, so I'm sure you've all seen this. But certainly, if you have any questions on it, please reach out to your local regional director or myself, and we'd be happy to talk you through any questions you have. And last but not least, we have partnered with Pixelworks, a local print shop in Ottawa that has been a 15-year supplier of ours and a 5-year sponsor of the Take a Kid to the Course. Again, they are a signage shop, so offering a variety of different signage options for you at considerably reduced prices. So if you're looking for any signage or getting anything done for the start of the golf season, which we all hope is soon, please look into Pixelworks as well. So I guess just, for additional information, again, don't hesitate to reach out to your regional director. NGCOA.ca remains a great resource for all things COVID, and during the NGCOA for all of our opportunity buys. And then just to close, I'd like to give you one more thank you to Club Car, Integra, Moneris, Moosehead, Tion, and Toro for all of their supports with their webinars, with our webinars across the country.
Wonderful. Thank you very much, Riley. We really appreciate you and Kyle's efforts with working with these suppliers to get get products and promotions for our membership during this COVID-19 pandemic. So thank you. Now, please remember that if you have questions during the next part of this webinar, you can use the chat function down at the bottom of your screen. Those questions will come across to us. We'll sort through them. My colleague Blair will be jumping on throughout the presentation to ask some of these questions. And just a reminder, if you do want to keep it anonymous, just please let us know. So what I'd like to do now is, basically the main reason why all of you have joined in is to find out a little bit more from our experts at KPMG. So I'd like to introduce the three main speakers for today. Barry Travers, as you see, partner in tax. Aaron Gillespie, who's a partner in enterprise tax. And David Ahern, who's the Senior Vice President of Corporate Finance. So Barry, please take it away.
Thank you very much, Sean. Really appreciate the time, and certainly KPMG supports the industry, and we hope to see everyone get back on their feet. As everyone knows, KPMG stands for Keep Playing More Golf, so we're extremely supportive of the sector. So in terms of the information that we're going through today, once the slides come up in front of me, I'll be able to walk you through. So we've broken this up into 3 separate sections. I'll be talking about the wage subsidy programs at the outset. I'll spend about 20 minutes doing that. And then Aaron is going to go through and talk about all the other supplementary tax programs that are available that have been announced in terms of how they work to support you as employers. And then finally, Dave will go through and talk about some of the financing arrangements that have been made available and cash flow planning in terms of the sector and overall that the government have announced. So if we could flip to the next slide, then we'll be able to kind of move our way forward. The subsidy programs. Perfect. Okay, so we'll start with the temporary wage subsidy. And I think this is really important. We've got a lot of information on the slides. We did that purposefully to have as a leave behind so that you can go through and work with them. We may not touch upon absolutely every point that's raised on the slides, but you have them to take away. But I do want to make some very key points, starting off with the 10% temporary wage subsidy. So this was made available at the outset, starting for pay periods and for work provided March 18th through to June 19th. This was the initial program that was made available. And it's pretty important because they didn't essentially replace this program with the 75% program. This program is still in play. And they actually, the 2 programs interlock. So you're actually required to use this program and then reduce any claims that you make under this program if you qualify for the 75% program. You can't just jump into the 75% program and say, I'm not going to worry about the 10% program. This was made available to organizations that are small business, so Canadian controlled private corporations that have taxable capital of up to $15 million. So essentially, any small business that has access to the small business deduction was able to take advantage and is able to take advantage of this program. It includes partnerships, individuals, any charities or NPOs. So obviously, a lot of golf courses, member courses operate as NPOs. They can take advantage of this. And how this one was claimed, it's simply 10% of the remuneration paid during the pay period. Now, it had a maximum of $1,375 for the duration of the program per employee, and an overall maximum for the employer of $25,000. And what you actually do is you take 10% of your remuneration for a pay period, and you simply withhold that amount or do not remit that amount when you're making your regular payroll remittance. So there's no forms to file, there's no application to make. You simply reduce down your withholding remittance by that amount. And as I say, extremely important to do this because the government, when they process the 75% claim, they'll assume that you'll have made this claim. So you really need to make this claim and then reduce your 75% claim, if you qualify for that one, by the amount that you've claimed under the temporary wage subsidy program. So just wanted to highlight that off the start. So if we can move forward, we'll now talk most of the time about the 75% wage program. So if we just flip the slide to get to the next one, that would be great. Oh, okay, perfect. Okay, so the eligible entities. So they're much broader in terms of the entities that are eligible for the 75%. I call it SWEES. Different people use different nomenclature, but my maritime background, I'll go with SWEES. So this is available for organizations, corporations that are not exempt from tax. So this could be a foreign entity. It could be any type of corporation. Obviously, in the case of the golf course sector here, it's probably going to be corporations that are small business. It did apply to individuals and trusts. And once again, it applies to not-for-profit organizations. So a regular not-for-profit organization that a golf course membership arrangement would operate under, it qualifies for that as well as partnerships. So any partnerships, and there might be golf courses, there are golf courses that we know of that operate in a partnership structure where they may have more than one owner or partner, if you will. The partnership as well as an eligible entity to the extent that the partners themselves are eligible. So either individuals or qualifying corporations. So that's kind of who qualifies. So now if you look at the qualifying periods, there's the distinction between the month that you've probably heard a lot about this revenue reduction test, and we'll go through that a little bit, but the revenue reduction test, that applies to the actual calendar months. So for the months of March, April, and May, it is the full calendar month that you're measuring. So let's take March, for example. What you would do is you'd say, okay, I look at March 2020, I compare my revenues that are actual in March 2020. I can either compare them back to March 2019, that's the first comparative option, or I have an alternate option that I can compare to, and that's the average revenues for January, February of 2020. Now, I would suggest in the golf course sector that for the most part, the revenues in January and February might be a little bit lower than they would have been potentially in March of 2019. So one would think that March will be the better comparator, because obviously you're trying to have a comparator where you can demonstrate that your revenues have dropped in March 2020. They have to drop by 15% to qualify for the month of March for the subsidy program. And then once you've determined whether you qualify for the month of March, the actual pay periods that it covers is wages paid in respect of the pay period spanning from March 15th to April 11th. And they refer that to qualifying period 1. So that's the first qualifying period. If you meet the test for March, then the legislation actually deems that you've qualified from a revenue test perspective for the first subsequent month, so the month of April. So you don't have to meet the revenue test for April to do the April to April comparison, to April 2020 back to April 2019, because you qualified for March. So there's a rule that it's 1 month following, the first subsequent month following, you're deemed to qualify if you meet the revenue test. So you can see that obviously
Do you mind just slowing down just a little bit? There's a couple people saying you're speaking just a little too fast. Thanks, Barry.
Okay, no problem. No problem. So there's a lot of stuff to cover, so that's why I'm trying to get it all in, but we'll slowly kind of go through this. So April, again, is if you look at April 2019, you're comparing that to April 2020 if you need to. In other words, if the March period otherwise, let's say you didn't qualify for March, so now you need to qualify for April. You'd look from April from the prior year, 2019, up to April of this year. That's now the qualification period for the month of April, and the pay periods associated with the April period is April 12th to May 9th. So you can see that the qualification month from a revenue test is the calendar month, but yet the pay periods associated that you're actually claiming the subsidy on, they're the ones in the right-hand column for the pay periods April 12th to May 9th. And then the third month, of course, is the month of May. So if you've otherwise qualified for the month of April, that would mean that you're automatically qualified for May if you meet the revenue reduction test. So you don't need to re-qualify. And so the pay periods that will associate with the month of May will be the pay periods for pay in respect of May 10th to June 6th. So at this juncture, it is 3 months. There's a lot of discussion as to whether, in fact, it could be extended to the month of June. That's possible. The way the legislation was built, they actually had it such that they can add prescribed periods, so they don't need to bring back new legislation to add an additional month. And given how slowly things are reopening, there's been lots of discussion that this may be extended, but there's been nothing official at that point. But just to let you know that that capability exists in the legislation that's written today. So now if we kind of go on to look to see, so what are the actual remunerations that qualify? So the first thing that they did is they actually built in this concept of baseline remuneration. And baseline remuneration is it's measuring the remuneration that were paid to your employees from January 1st to March 15th. And the reason that they did that was they said, okay, well, if someone's got normal earnings, we'll call it, or the average weekly earnings during that period, we're going to make sure that under the subsidy program, that when they're calculating the subsidy, if they actually pay the person, that we'll give them up to 100% of the first 75% of their pay. So that's one of the features of the program, is that the subsidy, if you're paying somebody 75% of their normal pay, if they in fact had baseline remuneration, so regular earnings from January through to March 15th, then you would get a subsidy, a full 100% subsidy on the first 75% you pay them. The challenge, of course, in sectors like the golf sector is that likely for many of your employees, you would not have baseline remuneration, because for the workers, for example, that you're hiring, the seasonal workers, they would have no baseline remuneration. That number would be 0 because you weren't paying anything to them during the period of January to March 15th. So this might work well for your general manager or for other full-time staff, that they would actually have baseline remuneration, but this is a challenge we've seen in sectors that are seasonal, that there simply is no baseline remuneration. The other aspect of the test, of course, is just 75% of the actual wages paid. So you can get that amount of the subsidy if they have no baseline remuneration, and we'll go through a little example of it in a minute. The other key thing with the with the qualification is that employees must effectively be not without pay, so not without remuneration, for more than 14 days within the 28-day period. So each of these qualifying periods, so the first one being the March 15th to April 11th, that's 28 days. That's the length of the first qualifying period. So essentially, if they were without pay for 14 days, then they would not qualify. The employer would not qualify to claim the subsidy on those individuals. So that's that's a criteria that to make sure that you're under employment and receiving remuneration for more than half the period to qualify for the subsidy. If they work for 3 weeks during the subsidy period, then you actually get the full amount of the subsidy if you otherwise qualify. So it was really just trying to make sure that they received pay for at least half of the period of time to qualify. There are a lot of employers, and you've probably seen in the paper, Air Canada recalled all their pilots, 16,000 pilots. And what they did on that was that there's this feature in the program that can actually retroactively recall someone. So say you laid them off on March 18th and they're without pay and they're claiming the CERB, which Aaron will talk about. There was the ability to recall them retroactive to the day that they were laid off. And that way you actually got the subsidy because they switched over from being on the CERB to actually you receiving the subsidy for that. So a lot of employers retroactively recalled their employees to their layoff date in order to get the subsidy for those employees, which was a higher amount in their hands as opposed to the employees just simply getting the CERB. The actual calculation of salary and wages, it includes pay to part-time employees, seasonal workers. So, it includes all amounts that are paid. It includes all benefits as well. So all taxable benefits with the exception of stock options that are either paid or reported in a qualifying period count as salary and wages for purposes of the calculation of the subsidy. But again, you'll see in the next slide when we go to the actual calculation, if we can just flip forward one slide, that this baseline remuneration concept is quite relevant. So before I get to that, I'll just make a mention of a couple other points. So there is maximums. So there's a maximum where anybody that's earning more than $847 a week, that's the maximum amount of what you're going to get by way of the subsidy. So on an annualized basis, it's $58,700. The one key thing here for individuals that are owners, so I'm sure many of you people, they're in the calculation, they actually needed to have baseline remuneration. So somebody that was considered to be dealing with the entity, the employer, on a non-arm's length basis, so they held more than 50% of the outstanding shares if it's a corporation. In those cases, they ensured in the formula that they would only be eligible for the subsidy to the extent that they had actually received pay. So they had baseline remuneration for the period of January 1st to March 15th. So if you receive dividends only, that's not remuneration, or if you just happen not to pay yourself a salary during that period of time, you would be ineligible for the subsidy on your pay starting March 15th because in effect you have no baseline remuneration. So that's a bit of a disadvantage for owner managed business. We've got a lot of clients that have dividends is the way that they pay themselves, and in those cases, if they did not take true salary and wages during that period of time, January to March 15th, then they're not going to qualify for the subsidy. So now let's go forward and just kind of look at the formula, and I'm cognizant of the time not to dwell too much on some of the details. So it's a two-part formula, A and B, in terms of the actual calculation. So you can see that in the first part, this is the straight 75% of remuneration paid. So in many cases, for say your seasonal workers or the people that have no baseline remuneration, that's going to be the calculation of the subsidy. But the formula did provide for the greater of the two. So the second part of the formula is where we get into this 75% of this baseline remuneration, which essentially in some cases might be somewhat higher than just 75% of the straight remuneration paid. Best illustrated by way of an example. So if we go to the next slide, we'll just go through a quick example, and I'll just pick one of these scenarios in the interest of time. So if we look at scenario 3 here, let's assume somebody that was working January through to March 15th, that their average wage was $1,300 per week. Let's assume that's therefore their baseline remuneration. During this this first qualifying period, let's say the organization paid them $800 per week. So that's, they chose to pay them 75% of their normal wages. You can see on the next slide, when we go through the calculation itself, that it's going to, that the actual amount that they paid under scenario 3, the $800 is what's going to prevail. So the full amount of what they paid that person is actually the subsidy amount, and that's driven off the second part of the formula. So this B in the formula where they say that remuneration paid up to the $847. So obviously they're not over the maximum, but by virtue of the fact that they do have baseline remuneration, that means that the full amount that they paid the person, the $800 in that example that they paid them, is going to be the amount of the subsidy. So it replenishes to the employer the full amount of what they paid them, as opposed to just 75% of what they actually were receiving. So that's a real advantage of the program, that that a lot of employers have effectively reduced their remuneration to 75% of what they're otherwise making if they're in a business where things are otherwise shut down, because that way it's going to guarantee that they can get them 75%, and it's not going to cost the employer anything, because that's the amount that they otherwise have paid them as their adjusted pay. So if we kind of just look at the revenue reduction test, so the key part of the revenue reduction test, as I said at the outset, is that you're really comparing a month to a month. So you're comparing what was the case in March of 2019, and it's all your revenue. So you actually go through and look at all the revenue of the entity. So let's say it's a corporation that otherwise earns interest, it earns dividends, it earns revenue from golf, it earns revenue from your restaurant. All of that is considered to be qualifying revenue. It's earned in Canada. And the only things that were excluded out of revenue that you actually adjust for is extraordinary items, and I would say that would be a very, very rare occurrence. It would be like a building that burned down that you got insurance proceeds for, perhaps, but there's not going to be many extraordinary items that you would exclude from your revenue. But the other point, the key point that revenue does not include is capital gains. So if you happen to have a capital gain, so amounts on account of capital, they are excluded from the revenue test when you're comparing your March to March, for example. So you'd exclude capital gains from both comparative periods in determining whether you've met the revenue reduction test. So that calculation, for something that's been shut down is a lot easier to do, because most of the organizations that we worked with, their revenues have declined significantly, and so doing the comparative for the month of March at 15%, they've just done a straight month-to-month comparison to see whether they qualify or not. There are special, yeah.
Oh, I'm sorry. I just wanted, someone just asked if you could repeat the example. They didn't understand it quite clearly.
Okay, sure. We can go back. So the example, what it's doing is, in this case, let's go back to scenario 3. It's a two-part formula, and that's why we'll leave these slides with you to be able to go through and look at how the formula works. But you can see that it's a two-part formula. It's the greater of the two segments of the formula. So in this case, as you recall, the individual normally made $1,300 per week. So during the January to March 15th period, they were paid $1,300 per week. That was their average pay. So in the formula, you'd say, okay, well, and we've adjusted this person's pay to $800 per week during the month of March because of the pandemic. That things are slower, so the employer has decided to reduce down their pay to $800 a week. So you can see what the formula does is it really looks at the two comparatives. It says, okay, well, in the first part of the formula, if we just simply took 75% of what we paid them, so 75% of $800, that would produce an amount that otherwise we would be eligible for of $600. So you can see in the right top bracket, that's the box, that's the $600. But the formula goes on to say, but it's the greater of A and B. So B in the formula actually looks at what the person's baseline remuneration was, which, as we know in that example, was $1,300 a week. So 75% of $1,300 is actually $975. So you say, okay, well, based on baseline remuneration, the subsidy could be up to $975, but we only paid the person $800. So that's the one that's in the middle. So that's going to drive the actual ultimate subsidy amount. So in the case of scenario 3, we paid the person $800, and now we're going to get a subsidy of $800. So it's not costing the employer anything. What they paid them is the amount that they're going to get by way of a subsidy. Okay, is that hopefully clear? Okay, so a couple of things to be very cognizant of by way of issues. So in making the subsidy claim, you go through and you look at your revenue, you determine whether the revenue decline, has been achieved. Are you down by 15% by way of revenue in the month of March? You look at your pay that you actually paid your employees. You calculate what the subsidy amount is based on that formula that we provided. Now you're going on the CRA website under your My Account to make the claim. If anybody has gone on that site yet, you'll see that there's some information that you need to populate. You need to populate what the actual remuneration paid was. You need to indicate whether you retroactively called back any employees or not. And then you indicate the amount of the subsidy that you're actually claiming. You also indicate some other information on the temporary wage subsidy, what you're eligible to claim. And then there's a box that you have to click that essentially is the attestation, and this is done by the person that has the primary or principal responsibilities for financial activities at the business. They have to make this attestation, and it's a 12-point attestation, like it's quite long and involved, and essentially you're attesting to the fact that the application is complete and accurate in all material respects. So that's a fairly onerous test, and the issue is that many CFOs are nervous about, quite frankly, is the fact that the fine, while they state the fine to be 25% financial fine, in actual fact it goes up to 225%. So under the Income Tax Act, there's a penalty for making a false statement where a tax filing is made that imposes a penalty of 200%. You add that to the 25% additional fine that they've put in place for this program. And they add on top of that there's up to 5 years in prison for a material inaccuracy in the submission. So this has employers quite nervous, quite making sure that they've had their homework checked, if you will, before they make that attestation, because the government has told us very clearly that they plan to impose these penalties, the financial penalties, and if they feel that fraud was committed, that they'll go with the jail time. And they told us on the first day of submissions that there was 25 incidents of you probably heard in the paper, the 20,000 submissions that were made. They have 25 incidents where they are pursuing what they believe to be fraudulent activity, and they're going to take it to the full course of the law. So they told us that in a meeting that we had with them 2 days ago. So the program opened up for submissions this past Monday, April 27th. There is a feature that also allows for the ability to claim back the employer portion of any EI, CPP, or QPP that was paid and therefore withheld, remitted, paid to the government. This is just the employer's portion. Where any employees were actually on leave. So let's say you have, you're closed, so you otherwise have the person on leave, you otherwise have paid them. So in that case, you would have remitted CPP EI on the employee portion. You would have matched that on your employer portion. And what they're allowing organizations to do when they actually make their subsidy claim is they're allowing them to reclaim or take back the employer portion of the CPP and the EI as part of the subsidy claim. In that same filing, just before you flip slides, just go back, in that same filing as we talked about before, this is where you indicate if you were eligible for the 10% temporary wage subsidy. So if to the extent you're eligible for that, you need to indicate that on when you file your SWEEZ claim, and and that will otherwise reduce the squeeze claim by that amount. So that's why I said before, it's very important to make that 10% claim separately. And as well, if you have any work share arrangements, so sometimes employers will have a work share arrangement where they have maintenance people that essentially are under an EI program of work share. So in that case, any EI that those individuals have received, that's required to be reduced off your squeeze claim as well on the form when you submit. So the input, as I mentioned, there's 4 boxes that you're inputting information when you actually make the claim related to the subsidy and the salaries actually paid in the period, as well as the CFO attestation. And as I mentioned before, if you qualify for the month of March, you're deemed to qualify for the revenue test for the month of April. If you then qualify again for the month of April on the revenue test, then you're automatically qualified for the month of May. So really there's, at this point, while there's 3 months of the program at this stage, there's really only 2 periods that you need to qualify from a revenue reduction test. And many businesses that we are dealing with are saying, okay, I'm going to qualify for the month of March. I'm going to attempt to qualify. I'm also going to attempt to qualify for the month of April under my revenue test. That way I deem the month of May to be the month that I otherwise don't have to otherwise qualify, because that will be the automatic one, as opposed to doing it for March and May. And the theory behind that is that, initially people were saying we hope to be up and running again in May. So May might be a harder month to qualify under the revenue test. So why not try to do it under April and cause May to be the month that's the deemed month that's accepted? So, that's something that in your business, you have to look to see which do you believe you'll be easier to meet. And if you think that you can qualify again in April, allow May to be the deemed month of acceptance. And to the extent that you claim the SWEEZ subsidy, as you may have seen in the paper, there is the CRA have made it they have it in the capability to make the information publicly available. So they plan to do that, where they make, somewhere they're going to post the names of the organizations that have actually made the claim and the dollar amount of which they've claimed. They'll also make that information available, obviously, to Service Canada as it relates to the CERB payouts. So, this information is going to be publicly available to everyone that otherwise have made the claims. So that's a bit of the summary on this program. The last points are, payout. They expect to be, the first payout is expected to be May 7th. So for people that filed this past Monday, they committed that will be the first payout date. So they're saying, between 7 to 10 days going forward should be the expected time of payout. So that, that means the mid part of May that you're otherwise going to receive your monies. And then, the theory is that you'll make your next claim for the month of April shortly thereafter in terms of continuing along with the program. So that's the theory in terms of timing. So with that, I'm kind of at my time. We'll certainly be around to answer questions at the end and circle back. So you don't have to worry, we'll clarify all the points that come up. So I'd like to turn it over to Aaron now for the next segment.
Hey, Barry, just before you go there,
Yeah.
I do have a question that came in. A small golf course that has no employees over the winter and doesn't usually hire anyone until about mid-May, or
Yep.
mid-April.
Yep.
Would they be eligible for the Canadian Emergency Wage Subsidy as there are no employees during the time period of January 1st to March 15th?
Yeah, they won't have any baseline remuneration, so they won't be able to get the 100% of the first 75%, but they'll definitely still be able to potentially, if they have the revenue reduction test, if they meet that, they can still, under that formula, of the formula was 75% of the actual wages paid. So, as long as we're not talking about the owner, the shareholder that has more than 50%, but on their employees that they otherwise just hire starting in the month of May, if they qualify in May, absolutely, they'll get 75%. But that means that, if they're paying them $100, they're getting $75 as their subsidy amount. They're not getting the entire amount that they pay them as a subsidy. That's only the entire amount of which they pay them is only potentially available if they had pay between January to March. So that's the difference between that calculation.
Okay. I assume we're good on questions for the moment, and I'm sure there'll be more at the end, Barry. So thanks, Barry. Hello, everyone, and I have to echo the comments that I certainly hope to be back on the golf course as soon as possible. Quick as a reminder, everyone should know that it's important to monitor the status of the various programs. We are waiting for further details on some, others are changing, and new programs may be announced at any point. The ones I'm going to go through are not an exhaustive list of the programs, but they're the ones I think would be of most interest to you. So on the next slide, the first one is the SERB, is the acronym. And the SERB is a benefit for individuals who are not able to work due to the pandemic. It applies to employees or self-employed people who are eligible for EI otherwise, or who are not. The benefit is equal to $2,000 a month to a maximum of $8,000 per individual. And the program runs from March 15th to September 26th. I'm going to go through these fairly quickly because I do want to make sure we have time at the end to discuss the financing and credit options that are available out there to folks. The next slide is related to what's called the Supplemental Unemployment Benefit Plan. If we can just move that slide again, great, thank you. This plan allows an employer to top up employees while they're laid off and are receiving EI or SERB. And so you can think of it as a comparative to like a traditional maternity or paternity type top up plan. And so it allows the employee to collect the EI or the SERB, but allows the employer to top their salary up, doesn't have to take them right up to their previous wage. It can only go up to 95% of their normal earnings, but allows them to give them some kind of top up in excess of EI and SERB. And the big advantage of the sub plan, as it's called, is that the earnings do not qualify as insurable earnings for the purposes of EI. So you may be aware of that clawback, where the employee earns money, they have to claw back those benefits. The sub plan income does not qualify for that purpose, so it's a good advantage to the employee. The next one is the work sharing program. This is a program that allows employees to agree to a reduced work schedule and share the available work among employees over a period of time. The program can run for up to 76 weeks. The big advantage of this program is that if employers are able to pay for the work that's performed, well, the EI system tops up the employee's pay. And by sharing the work, presumably this would avoid layoffs, has big rewards then from an employee satisfaction perspective. You administer the program on a work unit basis. And so a work unit is employees performing similar functions. So it doesn't need to be on a whole company basis. You can actually break it down and look at work units. The next one is a new one that was just recently announced. Oops, sorry, I got out of order here, no worries. We'll jump to the tax filing and payments, that's fine. What I wanted to highlight here quickly is that certain types of taxes may be deferred in order to conserve cash, and businesses and individuals should certainly look at this for sure. So these are just a few of them. There are more, but I'll highlight the most relevant ones. So income tax installments and income taxes that became payable after March 18th and are due before September 30th, they may be deferred to September 1st. GST, HST remittances that became owing on or after March 27th and before June of 2020, they may be deferred until June 30th of 2020. And probably a little less relevant, but customs duties payments for the month of March, April, May are extended till June 30th. And all these payments, you're allowed to defer them without any interest or penalties. Next slide. Perfect. Okay, so the student, let's see, the Canada Emergency Student Benefit, this was announced on the 22nd of this month, and we're waiting for some further details on it, but generally the program is designed for post-secondary students and recent graduates who are unable to find employment or unable to work due to the pandemic. And they'll be eligible, and the program will run from May through to August. And the benefit that they'll receive is $1,250 a month. Next one. Perfect. I did have the commercial rent assistance program. I'll just mention that briefly then. So the Canada Emergency Commercial Rent Assistance Program was announced recently, and we're waiting for further details on it. But I would just raise it to say that this is an interesting program between tenants and landlords and different levels of government. And effectively, what it's going to do is they're going to administer the program through CMHC, the Canada Mortgage and Housing Corporation. And effectively, it's a 75% rent subsidy for tenants. It's going to be administered by having the government provide a 50% subsidy to landlords, and provided the landlords reduce their tenants' rent by 75% or more, they'll qualify, provided other conditions are met. The program is going to run for applicable months of April, May, and June, and the subsidy runs as a forgivable loan through their mortgage lenders. The eligible tenants must pay less than $50,000 per month in rent and have temporarily ceased operations or experienced a 70% drop in their pre-pandemic revenue. We believe that we'll get the further details by mid-May and that it should be up and running by that time, but we shall see. There's going to be some interesting pieces to the program in the fact that we don't know if the property doesn't have a mortgage, what does that mean? Or for example, I think there's going to be some pressure between landlords and tenants as well, because the tenants are going to be asked to take a 25% haircut and attest to a number of tests that apply to their tenants, and the landlords are going to have to attest on behalf of that. So it should be an interesting program in terms of the actual dynamics of how it's going to operate. I'll stop there, and I hope that was a useful summary of some of the other programs that are available at this time. And with that, I'll pass it over to David to provide a summary of various financing and credit options that are available. Thank you.
Thanks, Aaron. Hello, everyone. I'm just conscious of time here, and I want to allow some time for questions. So, what I'll do, if you want to move to the next slide, I'll give you a brief overview of some of the main programs. Aaron actually stole some of my thunder there on the commercial rent assistance, that I have a bit of detail on there. So I'll leave that one off for now, because obviously Aaron went through that. But this is not an exhaustive list of the programs that are available, but I think these are the most relevant to most of the business owners who'll be on the phone today. And again, I'll go through this at a high level. So the first one that we have there is the CEBA, and this is the Canada Emergency Business Account. This provides a $40,000 interest-free loan to business that have payroll of anywhere between $20,000 and $1.5 million in 2019. This program has been up and running for a number of weeks now. It's accessed through your financial institution and is ultimately backed by the EDC. But again, this program's been up and running. It's for $40,000. It needs to be, if it's not repaid, if it's repaid before December 2022, there's a $10,000 loan forgiveness. So it's quite reasonable. And if it's not paid by 2022, then it's converted into a 3-year term loan at a 5% interest. Now, it's $40,000. It's not going to be the it's not going to be the amount that's going to suit all businesses, but it's certainly a starter for some of the smaller businesses out there. And it's a fairly, from what I understand from working through the lenders, it's a seamless enough program to get access to. The program that's going to be relevant to, I'd say, to the vast majority of people on the phone is the Business Credit Availability Program, or BCAP for short. There's two tenets to this program. One is a co-lending program through BDC, and the other is a guarantee program through EDC. Both of these programs allow for up to $6.25 million of credit to be made available. Now, there are certain restrictions on that, and normally it's to do with level of revenue. But ultimately, there's up to $12.5 million available through these two options. Now, the key point in understanding on the BCAP is that it has to be accessed through your financial institution. So with the government, because the government is going to effectively through EDC and BDC guarantee 80%, it means that the financial institution is basically going to be carrying risk for the remaining 20%. So, and as it's being processed through the financial institution, in order to access the financing, a client would have to go through their EI and undertake the standard underwriting procedures. A client must be in good standing at the time of funding, and can't go into default as a result of the loan. And these loans are primarily designed to facilitate working capital shortfalls over the next 3 to 6 month period. So again, you know, when people are applying for these loans, they need to be able to demonstrate that there's a cash requirement, and that, you know, the cash and the amount of the loan is going to be able to sustain the business over the next couple of months period. These facilities will be subordinated to any senior debt that is in place, and there are instances where the lenders may look for additional security, for example, guarantees, etc. And there will be limitations on what can be done with the money, and in terms of, you know, repaying other debt facilities, you know, taking bonuses and dividends, etc. But from the main tenets of a program out there, the BCAP program is probably going to be the most relevant to most businesses. I'll leave the commercial rent assistance program to the side because Aaron covered that off. But the other program that will be irrelevant as well is, and this is through the BDC, and this is a working capital loan. And this is to access this financing, you would need to work directly with your local BDC representative. So under this program, there's up to 2 million available, pretty similar to the BCAP program in that it needs to be purely for working capital needs. There's going to be restrictions in terms of what can happen with payments over the next couple of months, again, on dividends, repayments of senior debt, etc. But it's but again, this loan up to 2 million available purely for working capital. It's got a 3-year term, no debt repayments in the first 12 months, with principal repayments spread out over the following 2 years. If you want to skip to the next slide. Actually, you want to go to the final slide. Again, I'm just conscious of time here, so just go to the final slide. So, sorry, just to go back one. Yeah, just, you know, the one thing I want to just to stress to everybody here, when you're accessing these programs, and be it the BCAP program or the BDC working capital facility, it's going to be very important for businesses to react swiftly. You know, banks are getting inundated with financing requests, so there is going to be delays already built into the system. So companies need to act now. So, you know, when you forecast through the next 6 month period and you understand where your cash flow is going to be and understand the impacts on your cash flow, it's very important to put a package together, working with your financial institution, have all the necessary documentation, forecasts and financials prepared, outline the areas of vulnerability that you have, and then work with the financial institution to ensure that you can demonstrate by availing of these working capital facilities, how this can sustain the business over the short term. I suppose with that, maybe I'll just turn it over to Q&A again, just conscious of time.
Excellent. Thanks, David. I do have a question. I believe this will fall into Barry's domain. For the 10% withholding, what do you need to do before applying for the 75%?
So so if you think of the integration, firstly, if you have claimed the 10% and you're deemed to claim it otherwise, so when you actually claim the 10%, you, as I said, you will just withhold that amount from any remittance that you've made that the 10% has been calculated on. And then when you go to claim the 75%, you'll note that on the portal, when you actually put in your subsidy amount, there'll be a separate box that will actually say amount eligible under temporary wage subsidy. So that's where you'll insert the amount that you have claimed under the 10% program. And what it'll have the effect of doing is reducing down your claim under the 75% program by the amount that you otherwise have already claimed under the 10% program. So that's how the two programs integrate. It's a reduction of what you claim. You're still in effect getting 75% overall, because it's just that you got 10% initially through that claim, and then the amount got netted out when you claimed the 75% amount. So your net claim is still just 75%. In essence, you don't get both. You don't get 85%. You're getting a maximum of 75%.
And Barry, it's Aaron. Maybe if I can add one quick thing there, is that when to the question is that what you need to do is determine your eligibility for the 10% subsidy, because the eligibility for the 75% subsidy and the 10% subsidy are quite different, very different. And so the individual asked, what do they need to do? Well, for a starting point, determine whether you're eligible for the 10% subsidy. Because again, as Barry said, it reduces the 75% subsidy automatically.
I have another question that came in here. In the revenue calculations, do you only exclude capital gains or other capital revenue, such as capital assessment and entrance fees?
So certainly, when you think of revenue, it's under normal accounting practice. So revenue from one period to the next would be the normal revenue that you would report. And the way they described it was from your ordinary activities. So investment income is clearly an activity that it's based on your resources. So that's why investment income gets included. But by virtue of the fact that a capital gain is not typically part of your ordinary activities, so you dispose of an asset and you realize a capital gain, that's why amounts on account of capital are considered to be excluded, because your normal accounting practice, you would not normally report that as revenue. It would be a capital gain. And you think of a financial statements in many cases where a capital gain is reported, it's not reported as part of revenue. It's a separate line item, typically down towards the bottom of your income statement. So that's why capital gains are not included. But any other amounts that you've received that are part of your normal recurring revenue activities, those are included within your revenue item from the comparative period to the actual period that you're looking at.
Thank you.
All right. Well, it looks like we've got enough questions and answers there. Just keeping everything else on time. I'm just going to stop everybody there at that point. I want to definitely say thank you very much to Barry, Aaron, and David. That was a fantastic presentation. Just due to timing, we're going to stop there. However, as you see up on your screen, Barry, Aaron, and David's emails are right there. They're happy to answer any questions directly. As well, just send your email to Greg, Blair, and myself, and we'll make sure that the experts at KPMG get those. We want to make sure that we get all the questions answered as best as we can. But obviously, there's a lot of people on the call, and there's only so much time available. So once again, thank you very much, Barry, Aaron, and David. We really appreciate you joining us today. And what we're going to do now is shift gears a little bit. And I'd like to welcome in my colleague, Greg Chambers. Greg's going to go through the survey results from the member survey that was done when you completed your registration for today's session. So without further ado, over to you, Greg.
Hello, everyone. I will now be going through our survey results that we asked Ontario golf course owners and operators to submit. I'll quickly go through them. You're going to receive an email with all the details. A few anecdotal notes I'll throw in, as many of the survey questions will answer a lot of the non-KPMG questions that we received. At the end of the survey, I'll try to address a few more questions we received that will not be covered today. Okay, one quick note before I jump into the first couple of questions of the survey is that I have to remind everyone about the Competition Bureau of Canada's Competition Act, specifically provision 45, 46, and 48, which prohibits agreements between two or more parties to prevent or lessen competition. When discussing our first two questions, it is strictly the aggregate response we are looking at. All right, so as we jump in our first question, once open, how will you handle your green fee rates? 77% responded with keeping green fee rates the same. A significant note to this that I hear proposed from owners and operators a lot is twosomes and families only in a group. Contrary to popular belief, BC, Saskatchewan, and New Brunswick have no restrictions on who plays in each group. Twosomes, singles, although no walk-ons, knowing each other or not knowing each other, you still have the opportunity to fill the groups in advance when bookings are coming in to make a full foursome. Lots of feedback also from Ontario chapters about taking payment in advance online if you have the software or over the phone to reduce the amount of no-shows or last-minute cancellations. Our next question, once you open, how will you handle your cart rental fees? Again, 70% responded with remaining the same, with 25% replying that they will increase their cart fees to possibly be explained by only having one rider on a cart, which is mandated in the other 3 provinces currently, unless a member of the same household is on that cart. Next question, with the season starting later than normal due to COVID-19, are you considering reimbursement for a portion of the membership dues? 40% responded with no. Everyone else responded with some form of a credit depending on the length of the mandated closure, or they had not opened or collected member dues yet. No one responded with the option of a refund given to members. Some will decide though, as when an actual date is decided on, if a prorated discount needs to be given if there is a much later opening. Our next question is, how do the number of events at your course in 2020 differ from the events held in 2019? 63% responded with down over 25%, and 86% overall responded with some form of loss. I've heard that many courses are making sure not to let the event cancel, but moving to much later in the year, or at the very least, into the same date in 2021. Obviously, weddings are not as flexible. And our next question, as a result of the COVID-19 crisis, will you change your event's reservation cancellation policy? 66 respondents said no. A very small percentage said they would include verbiage to include a full deposit refund for natural disasters or pandemics, where there was no mention of any option for a refund or deposit before. Many are doing refunds on wedding deposits as to keep good relations and PR in the community. Our next question, simply, do you have an online store? 34 the respondents replied yes. And this ties in, if you do have an online store, what best represents your online sales of all items available to date for 2020? Out of the 34 respondents that have online stores, over half of those have made less than 10,000. We are hearing good stories though from great local and across the province stories of facilities using food and beverage, takeout online, supplemental income, and also helping with staffing. Our next question, have you or will you contact your suppliers to discuss payment options? Just over 73% have contacted or will contact their supplier to discuss payment options, including deferred payments or even reducing orders. Blair, did you want to jump in?
Yeah, Greg, in my experience, I think the best thing for a lot of our courses to do in that situation is simply just reach out to your sales representative for that company and see if you can work something out with them. And if obviously you don't get the answer you're looking for from there, then that's the time that you'd probably want to reach out to the company to find out what you can do moving forward.
Thanks, Blair. Blair was a past club rep for Callaway. Our next question is, what do you estimate your gross revenue losses to be for the 2020 season? Simply, 40% of respondents are estimating over a 30% loss for the season, with another 40% saying it is just too early to evaluate. Have you or will you make adjustments to your workforce? 85% of respondents are actually having reduced staff. This most likely covers F&B component, which will have many restrictions when courses do open. Due to the COVID-19 crisis, did you lay off any employees? This had varied amounts across the board, depending on when and if the facility had already opened. Ultimately, 55% of respondents had some sort of layoffs already. And related to that, if you had layoffs, which areas of the operation were affected? All areas of the facility saw a reduction in staff, with, as discussed in the previous slide, F&B was hit the hardest at 80%, but maintenance and customer service equally hit with 60% each. And our last questions of the survey, Once you open, will you implement best practices at your golf course, such as the ones recommended on the NGCOA Canada website? Great answer is 100% yes response. It's great to see that everyone is on the same page. Feedback from BC is that almost all courses are doing a great job and doing their part, with only a few lax courses in their protocols. The few lax facilities have been contacted by other courses to help if they can with resources or information. Reasoning behind this is they want to keep the golf out of the negative press and not to have one facility have the public health authority come down on the industry as a whole with increased restrictions or even closures. Now I'm going to take a few questions that weren't covered today. I believe Blair has the questions.
Yeah, Greg. The first question that we had is it my responsibility as a golf course owner to make sure that my customers and golfers are practicing safe social distancing on the golf course?
Good question. Yes, simple answer, yes. As an open business in Ontario, you must provide a safe environment for your staff and customers. If you're not providing a safe environment, you may be subject to fines or closure. This may have to consist of talking to staff or customers who are not doing safe practices and even issuing a warning or ultimately asking them to leave the property. This is no different than current stores that are open or essential businesses, grocery stores, takeout, etc.
Greg, another question here is when are the Ontario golf courses going to open?
Nice tough one. This is a tough and not always popular answer, but the feedback and information we've received from provincial governments, email replies, phone calls, meetings, and some of our connected members who have helped with contacts or lobbyists, it's simply numbers. I believe Mark has a slide. There we go. So as you can see, the provinces that are open have significantly less cases and deaths than Ontario. Although Ontario has also the largest population, comparing the cases per person, percentage-wise in each province, Ontario is still high. No matter how much the Ontario Jobs and Recovery Committee agrees with our information, they and Premier Ford are taking their direction from the Public Health Ontario Authority. Until they see a decrease in daily infections, they won't make a move adding more businesses to the essential list. Saying that, NGCOA, our 3 Ontario chapter boards, and our We Are Golf partners are always staying on top of the provincial government every day to promote the safe and healthy activity of golf, and that we should be atop the list of non-essential businesses to open first.
Greg, can we get the Canadian summer jobs that was at a 50% to increase to 100%? Can we receive the benefit of that?
Good question. I get that a lot, actually. When the government upped it from 50 to 100, we get a lot of emails and phone calls. Simple answer is no. The applications were closed on February 28th. Applicants would have already heard back from the CSJ program if you had applied. Saying that, we are looking at hosting a second Zoom webinar next week for the Ontario Job Matching Placement Incentive. We'll be giving out more information on that, and that is the local Ontario placements. And there's 3 different offices actually across the province that each chapter will be working with.
Greg,
so just want to remind everyone, oh, go ahead, Blair.
Sorry, just one more question that came in here. Are we going to be able to have a beer cart and deliver to groups from both the bar and the kitchen, food and beverage?
We're looking into it. Ideally, if your restaurant is closed, which every other province that is open currently is, what we're looking at is having some form of food and beverage run by the golf course, whether it's a safe halfway shack, whether it's a takeout window at the physical course or at the first tee. We've thrown around the idea of a beverage cart and see no problem at all with social distancing, payment through tap, payment through an account, leaving the beer or the food ordered at a safe place and driving away, and then the participants or the players pick it up. We're kind of pushing for that as an extra revenue source to kind of help out the food and beverage area. So just want to remind everyone, with hundreds of questions submitted today, if we did not cover any or answer your question today, please do not hesitate to contact Sean Blair or myself. And Sean also posted the KPMG guys.
Wonderful. Thank you very much, Greg. Thank you very much, Blair. I appreciate your help with that. I want to take a moment just to thank our colleague Mark Fraser, who is the technological wizard in the background that made everything come together today. So thank you, Mark. And a big thank you again to Jeff Riley and the experts from KPMG to join us today. On behalf of Greg and Blair, please let us know that please know that we are working really hard on your behalfs to get the golf courses open as soon as possible. And please don't hesitate to reach out to the three of us at your convenience with any questions that you might have. If you want to put that slide back up, Mark, there's our contact information there. Mark, if you put that up. Thank you. Once again, take a moment to visit our resource center online at www.ngcoa.ca resources. You'll find all the details on COVID-19 and some of the stuff from today as well. So once again, we did record today's session. We're going to be back in touch with you following this to give you a copy of the session as well as all the documentation that was in there. So without that, so I just want to wrap up there and say thank you very much to everyone for joining us today, and take care and be safe. Thank you.